Welcome to Money, Money, Money. I'm Samira Abdi. As much as Indian investors love the yellow metal, gold has been a thorn in the side of the Indian government, which has been desperate to get a handle on a widening current account deficit, and the government thinks it now has a way to ease this pain. Before I welcome my guest, Hemant Rustagi of Wiseinvest Advisors, let me toss it over to Cnbc TV 18's Alexander Matthew, who explores how the three gold-based schemes launched by the Prime Minister could actually help.
आज हमारे वित्त मंत्री जी ने हमें समझा दिया सोने पर सुहागा क्या होता है.
For Team Modi, controlling gold-hungry Indians during the festive season is definitely icing on the cake. And that's exactly what three new gold-based schemes are expected to deliver for the government. The first is the gold monetization scheme, aimed primarily at bringing gold held by households into the banking system. It allows an investor to deposit upwards of 30 grams of gold with a bank for between 1 year and 15 years. Investors can earn 2.25 to 2.5% on the weight of gold as interest. For example, if you deposit 100 grams of gold under this scheme as a short-term deposit, you will receive 102.5 grams of gold at the end of 1 year. That's the deposit plus 2.5%. This is payable either as gold or in rupee terms based on the value of gold on the date of redemption. Now, medium-term deposits spanning 5 to 7 years and long-term deposits spanning 12 to 15 years will only have the option of redemption in rupee terms. The second scheme is gold bonds. In this, the government will sell bonds where the underlying asset is gold. Bearing a coupon rate of 2.75%, these bonds will be open for subscription till the 20th of November. Investors can buy bonds worth between 2 grams and 500 grams of gold. The third scheme is a gold coin minted by the government bearing the Ashok Chakra, which investors can buy from banks. The government hopes to use gold collected under the gold monetization scheme to mint these coins. The hope is that these schemes will not only reduce the need for gold imports, but also mobilize household savings.
बचत के पीछे उद्देश्य होता है कि आपके लिए वो बचत हो, बचत के ऊपर आप थोड़ा कमा भी लें, उसका मूल्य भी बढ़ जाए, और जब वो बैंकिंग सिस्टम के अंदर प्रवेश पड़ जाए तो देश के विकास के लिए उस बचत का प्रयोग हो जाए. उसी दृष्टि से ये तीनों योजनाएं बनाई गई हैं.
But industry watchers say that unless the government throws in some tax relief through these schemes, investor interest may remain muted. Also, they point out that jewelry collection may prove to be a problem since it involves investors trusting government-appointed collection and purity testing centers to provide proper valuations. And that may take some time. So a rush to participate in these schemes may not be immediate. In Mumbai, Alexander Matthew.
Well, there could be a few niggling issues for sure, but we've had some time now to think things through. So let me now hand it over to Hemant. Hemant, what do you think of these schemes? Which one do you like best? And have you already started recommending at least one of them to your clients?
Well, let me begin with the gold monetization scheme, or GMS as it is called. I think it's a great idea, especially in Indian context, considering the fact that we have 20,000 tons of gold lying idle in the hands of individual, charitable trusts and other organizations. And we continue to import almost 800 to 1,000 tons of gold every year, which obviously has a negative impact on your current account deficit and trade deficit, which in turn impacts inflation and interest. So obviously it's a great idea. What the government is trying to do is to convert unproductive asset like gold into something productive. And I think it's a win-win situation for all the three entities, namely the investors, because they earn some interest which is tax-free, for the government because it can cut down his import bill, and for the local jewelers, they get the recycled gold without any import duty. So obviously the gold prices are likely to come down. So I think it's a great scheme. Obviously, as everything else, it has its limitation. We'll have to really go and see how successful it is going to be. If you look at gold bonds again, I think it's a great option for someone who is looking to buy gold for the purpose of investment. It's a very, very simple way of buying gold. It has all the benefit that you get from physical gold. And you don't have to worry too much about purity of gold. You don't have to worry about safekeeping of gold. You end up spending money because you hire a locker or you buy insurance. So clearly there are pluses, but even here there are some negatives which one really compares with other options. But like I said, it depends on what kind of investors are looking at and how they actually consider these two options.
Okay, you keep referring to it as a good idea. So is it that it's good in theory but not so good in practice?
Some of it, yes. That's what I really mean. It's a good idea. Like I said, I gave the context as to why I feel it's a good idea. But if you look at, let's say, GMS, okay, it's basically, we used to have this gold deposit scheme earlier, which was launched in 1999. That scheme didn't do very well. I think there were two main reasons for that. One was the rate of interest was being offered as 1%. And the minimum gold that one had to deposit was 500 grams, which was basically meant for charitable trusts and other religious institutions. This time around, the government has ensured that this GMS is more flexible because the minimum gold that you need to deposit is 30 grams. And it can be in any form of jewelry or bar or gold coin. And for the maximum, there is no limit. It has, three schemes, basically, three deposits which are there. One is a short-term deposit, which is meant for 1 to 3 years. Then there is a medium-term deposit, which is 5 to 7 years. And there's a long-term, which is 12 to 15 years. For the medium-term, the tax-free interest is 2.25, and for the long-term, it is 2.5. So clearly, if you were to compare this with gold deposit scheme, which were there earlier, this is a better option. Like I said, again, you are converting your unproductive asset into productive. So as far as these are the benefits are concerned. But I think there are certain issues which are going to make it difficult for the government to mobilize a lot of gold here.
Yeah, and I think one of the biggest being that I don't know how, as attractive as you may make it, I don't know how one can convince Indians to actually access gold and not possess it, right?
See, this is clearly a cultural issue. Okay, the fact is that it is very, very difficult to convince Indians to part with the jewelry that they have, which they may have inherited from their family. Okay, they are emotionally attached to it. So it's very, very difficult to convince them to part with the jewelry. And this is not the only issue, in fact. Under the scheme, the gold has to be of 995 purity. The fact is, we know that there is one issue that has always been that the gold which is held in as a jewelry is not a very pure gold. So when they come and convert it into gold bars, okay, they are going to lose significant amount of money, which everyone knows today, that when they are holding jewelry, that this is what happens. But to book a loss, I think, which is again going to be a shock for them. So there are certainly issues, like we discussed, of convincing them to part with it, then to convert it into gold bars. So you also lose all the money that you spent as making charges. So there are costs involved, and there could also be issue of how do you, if the fear is that if the tax authorities ask me
but the origin of the
gold, it's going to be very, very difficult, because except for the last few years where the government has said that you have to submit PAN card, there have been some KYC norm for if you buy gold for above a certain limit. Before that, most of the gold was bought in cash. And if you have inherited from the family, there's no way you can justify from where this has come. So I think there are issues, cultural issues, there are issues of having fear in the mind as to how do I explain it to tax authorities, which I think will ensure that.
So when can we expect some clarity on this?
Well, Sumera, you can have clarification only on one or two issues. I mean, how do you address the cultural issues? There's no amount of clarification which is really going to help.
Cultural issues aside, I mean, this tax problem, for instance, could actually turn out to be a really big issue.
Yeah, I think at the most, what the government can do is to clarify that up to a certain limit, like if it is, let's say, 50 grams or 100 grams of gold, no source will be ever asked. That kind of clarification will definitely encourage people to come out and participate in GMS.
Yeah, right. I hope actually that comes through. But let's take a very quick break on that note. We'll come back in a bit, and when we return, we'll delve a little bit deeper into both the schemes, gold monetization as well as the sovereign bond scheme, and we'll find out the merit of each. Stay tuned to Money, Money, Money. Welcome back. You're with Money, Money, Money. Hemant Rustagi of Wiseinvest Advisors is our guide this week, and he's telling us how you as an investor should be looking at the new gold schemes launched by the government recently. So Hemant, we've discussed a little bit about what both the schemes are, but let's get into the finer details. I want to start with the gold monetization scheme. You told us earlier that, a lot of Indians, it'll probably be a losing proposition, so to say, if you were to deposit your jewelry into it. So can we then effectively rule out people investing it? I mean, is that your recommendation to investors?
Well, I think I would say yes. Largely yes, but I think there could be some people who may be thinking of remaking their jewelry after over a period of time. Because what happens is that if you have been holding jewelry for some time, and if you're not happy with the designs that we have because of new designs, if you want to remake them, and maybe after 5 to 6 years or 7 years, it definitely makes sense for them to opt for it. Because in any case, you're going to lose your making charges. In any case, the purity issue will be tackled. But for all those who are not going to be touching their jewelry, and like I said, because they're emotionally attached to it, I don't see them really participating in them. So I think I see it appealing to a limited number of people.
Okay, so one of the other problems you mentioned was that, you're going to lose out on your making charges, unless, of course, you're predisposed towards making it again anyway. But undercarroting is another big problem in India. How is that going to be dealt with?
Well, I think it's a major issue. Like I said earlier, if someone is holding, let's say, 50 grams of gold, so they actually calculate the value on that. Unfortunately, this is also true that whenever we talk about asset allocation or, looking at how much money has been invested, the jewelry is never considered to be a part of it. This is considered to be completely out of that process completely. So anyone who's holding jewelry thinks that, okay, I'm holding a jewelry worth, let's say, 50 grams, and you calculate value on that. You're not looking at, how much pure gold is there and how much is undercarroting is an issue. What happens here, when you participate in GMS, it actually gets converted into a real loss, which, like I said, everyone is aware of. But because you don't book the loss, you're not so much worried about it. So here, because you're going to be converting into 995 purity of gold bars, you're actually going to be suffer losses. So I think which is, again, going to be very, very difficult for Indian people to accept that. So this is another reason why I feel that, the common investor or Indian will stay away from this.
Okay, if I were to choose to take cash at the end of my GMS term, will the difference between what I deposited and what I take back be taxed?
No, good thing about GMS is, the rate of interest that we talked about is completely tax-free. So what typically happens is someone deposits 50 grams of gold. The rate interest which is paid also gets converted into gold, depending on whether you're opting for short-term or medium or long-term. In medium and long-term, it has to be paid in cash. But in short term, it has to be converted into gold. So you end up getting more than what you're getting. Now, whatever you get, for example, there will be change in the value of gold, irrespective of whether you take as cash or gold. Okay, none of this is taxable. So there is no wealth tax, there is no capital gain tax, and there is no income tax.
Okay, now coming to the gold bond scheme, it's going to be listed on the exchanges, right? But do you actually see a problem of liquidity there?
I'm not too sure how effective the listing is going to be. See, the tenor of the sovereign gold bond is 8 years, and you can start redeeming after 5 years. So I personally feel that anyone who's making up mind or going to invest or buy these gold bonds should have that time horizon in mind. Because I'm not too sure. Because, let's not forget that not everyone is familiar in terms of how to trade or how to deal in the secondary market. So for them, it is not going to be very effective. And even otherwise, I think it will also depend on what is the gold price as to how effective the listing is going to be. So which I think it's there. It's there. The objective is that during the first 5 years when you can't redeem, there is an exit option available for you. If you're really desperate that you want to exit, maybe you'll not get the right price, but you have an option of doing that. How effective it is going to be in terms of pricing, I think I have my own doubts.
Since it's going to be listed on the secondary market, also there are going to be a limited number of issuances. Do you see a grey market evolving over time? I mean, like in the case of the IPOs, for instance?
Not really.
No?
I mean, see, this is not the only option through which you can buy gold or acquire gold. There are so many options available for you. So I don't really see a grey market developing there.
Okay, how will this limit of 500 grams be monitored?
Well, I think the way it is going to work is all the designated banks except the RRBs are authorized to accept deposits. And what the government has done is it has notified this Collection and Purity Testing Center, CPTC, where you go and deposit your gold. They will issue a receipt. Based on that, the bank will issue a certificate to you. Now, the issue is obviously that if you go and deposit in different banks, that's again a gray area, which we don't know how it is going to be monitored. So if someone can have deposit account in different banks and they may actually end up depositing more. As of now, there is no clarity as to how this is going to be monitored.
And I may even choose to gift it, right? In which case, will it be considered in my limit?
No, it depends on how you gift it. I mean, for example, if it is held in the family and one decides to deposit in 5 different family members' name, I mean, there is no way you will know whether it has been gifted. You can actually show it as your own source. And then take advantage of the limit which has been set.
Yeah. Okay, the other issue is how does this compare with like a gold ETF or a gold fund, for instance? Could we ever see a situation where it becomes so attractive that we actually see an exodus from the traditional, now considered the traditional options into this?
Well, I think this is a very good question. Look, the gold bonds, if you really look at the benefits of gold bond, it's a very simple way of investing in gold. You don't have to worry about purity of gold. You don't have to worry about safekeeping of gold. So in that sense, gold bond is definitely a good option. But if you were to compare it with gold ETF or gold saving fund, I think there are certain advantages that which are available to investors for investing in gold bonds. The first and foremost, I think the interest that you earn, even though it is taxable, you still earn 2.75 on the initial investment amount, which is not available in those two options. The second major benefit is that depending on whether you invest in a gold ETF or gold saving fund, you have to incur charges ranging from 1% to 1.5%, which you don't have to incur when you buy a gold bond. So clearly in these two aspects, gold bond is definitely a better option. But there are certain issues which may negate all this benefit. One is that the gold bonds are not going to be on tap throughout the year, which means that you will be buying gold at a prefixed price. Now, for example, in the current issue, which is open till 20th, the gold price has been fixed at 2684 per gram. Okay, now you're buying gold at that, so which means that if they're not on tap throughout the year, you must have a lump sum money, which you may or may not have. The second advantage of when you're investing in gold saving fund or gold ETF is that you can invest every month. We all know that gold prices are always volatile and are likely to remain volatile going forward. Now, what happens is when you invest every month or you set up a systematic investment plan through, let's say, in some gold saving fund, you benefit from averaging. So the 2.75 interest that you get, which is also taxable, may not be enough to negate the advantage of averaging that you get, the benefit of averaging that you get investing in two options. Second option is that here the minimum investment has to be equivalent to 2 grams of gold. When you invest in gold ETF, the 1 unit generally is equal to 1 gram of gold, and some it is even half gram of gold. So you can actually start investing with lesser amount compared to what you have. So I think both have advantages and disadvantages. In my mind, investing in gold ETF and gold saving fund is still a better bet because, like I said, you can invest systematically and benefit from averaging, which can be a huge benefit.
Okay, but in any case, don't allocate excessively into gold, at least right now.
Well, I think you should not be buying gold just because it's a very simple way and easy way of investing in gold. I think at all time your eye has to be on your asset allocation. In any case, when you look at from asset allocation point of view, we never recommend that you should have exposure of more to 5 to 10% in gold. So if you have already done that, there is no reason for you to really go out and start buying these gold bonds. If you haven't done it, we've talked about pros and cons. Consider those and go and make your decision.
All right, so there's good and there's bad, and there's a disclaimer as well now. So Hemant, thanks very much for joining in and advising our viewers this week. All right, so I hope that advice works for you. Let's take another quick